Hello and welcome. You're watching all about your company here on ET Now. I'm Harsh Saita. Today we're going to be talking about AGI Infra. It's a real estate developer based in North India. It does more of beyond tier 2 cities. So, and that's one of the interesting pieces about this real estate developer. In terms of the stock price chart, well, that's not accurate because we've got a stock split and a bonus issue also, and therefore that doesn't stand. But it's a real estate developer based out of North India. It's done 3x since its NSE listing maybe a couple of years ago in 2024. It trades at a premium, in fact. It's one of those real estate developers trading at nearly 40 times earnings, trailing 12 months. Very large pipeline in terms of delivery, and that's really the main trigger. They are set to deliver at least 3 projects worth nearly 5 million square feet in this year itself by the end of FY27, and therefore you'll have that large revenue booking which will come in as a result of that, and that will likely compress your price to earnings multiples substantially. That's what we're looking for. They don't disclose their average realization per square foot, but we'll try to quiz management with regard to that. They're also diversifying into Chandigarh. That's going to be the new probably lever that they rely on in terms of development and growth. They've done a 75 crore fundraise as well. So that's the other piece that we'll probably quiz management on. A very large land bank is what they sit on. We know from past cycles that land bank isn't the best measure, but nonetheless, for a very low kind of debt company, to have a large land bank is definitely something that one needs to look at and consider while they are analyzing a company. So all of that, and along with it, they do clock a PAT margin of 20%, and that will likely sustain going forward as well. At least that's what it seems to be suggesting, or that's what the goal seems to be based on the presentations that they are putting out. They don't do analyst con calls, so that's why this conversation is just much more meaningful. Therefore, now let's take a look at what the company does. It's a residential group housing and commercial realty projects is what they do. It was incorporated in 2005 as a market cap of around 4,600 crore and is promoted by Sukhbir Singh and family. And he is obviously going to join us in the conversation today in a few minutes from now. Let's talk about the products. They do group housing. That's a predominant part of what they do. Multi-story residential buildings with shared amenities. They also do plotted townships, which is residential plots with internal roads and basic infra. They do commercial complexes as well, retail and office spaces within mixed-use developments. Rental of properties is also what they do, commercial assets generating rent. And then interior design services as part of the ancillaries that they do. They are also foraying into cold chain. That's probably one of the other levers which we might just touch upon in terms of what this means from a growth standpoint. Let me talk about the ongoing projects, just to kind of give you perspective. Around 69% of the projects are premium and luxury category. This is among ongoing projects. The ongoing projects has a square footage of around 12.7 million square foot, which is more than all of what they've done till now. So very strong pipeline all the way till 2031. You've got affordable housing, which is around 30%. And then you've got small amounts in office and retail space, which occupies roughly 1% thereabouts. You're looking at upcoming projects as well. And within that basket, you have 9.6 million square foot of upcoming projects. So in all, you've got nearly 22 million square foot, which one can see in terms of clear clarity. And 90% of that is premium and luxury. They have no affordable within the upcoming projects that are coming up, at least disclosed as of now. 5% is office, 5% is retail. There is an intent to diversify outside of residential, and that is visible in the upcoming projects that they're taking up. In terms of the business model, they of course buy or partner with regard to land. They obtain approvals, build projects, customers book units, they pay installments depending on the construction phases of each project, and collections and fund construction happens, of course, and there's very limited reliance on bank debt as well, as you will see on the books. So that's broadly the way in which they operate. In terms of the geography, limited to Punjab at this point. They do Jalandhar, Kapurthala, Ludhiana, Chandigarh. That's where their projects are broadly in. Chandigarh, a lot of it is upcoming. So nothing really, or rather a lot of it is upcoming, nothing ongoing at this point, especially where Chandigarh is concerned. Now, what I've tried to do is just try to highlight that what does FY27 hold in store. You've got Sky Garden 2, which is one of their projects, Sky Garden 3 as well. When you're looking at that percentage, it's percentage of ongoing, which is 12.7 million square foot. 5% of that is Sky Garden 2. Around 2.5% of that is Sky Garden 3. And around 12% of that is Smart Homes 2. And that's the square footage as well. And this is yet to be sold square foot. So one is already sold, which will obviously get recognized. Some portion of that based on completion will come through in FY27, but this is completely yet to be sold based on square foot. That will also help us with the maths with regard to how much of realizations are there in each of these three. Will this be sold post development? And if so, what's the kind of numbers that it will clock, whether in FY27 or whether in FY28? We'll get a sense of that as well. In terms of land owned, they've got 7.1 million square foot. I spoke about this a little while ago, which is around 164 acres of land, which they continue to own even now, which can get developed in the future. In terms of the financials, and let's talk a little bit about the growth, etc. The last 3-year CAGR in terms of top line has been around 18%. They've been quite consistent with their development. As you can see, the growth has been at a decent clip. When you're looking at the EBITDA as well, you've seen a very decent kind of growth in EBITDA. Again, very consistent growth. When you're looking at it on a YOY basis, it's been 24% 3-year CAGR, so it's doubled of a very low base, of course. And then when you're looking at even the profitability metrics, the profit growth has also been at a decent clip. And you've seen a 23% growth in net profit. EBITDA margins as well have actually gotten better as we've gone by, and they typically clock a PAT margin very consistently of 20%. And that seems to be the goal as well of all the projects that they take up. That's the EBITDA margins in front of you. You've seen a bit of a spike in FY26 in terms of that margin. Let's look at, in fact, the 9-month numbers as well for FY26. 10% growth on top line, 31% growth on EBITDA, and net profit growth of 36% is what this one has clocked over the last 9 months. In terms of the balance sheet now, we'll switch focus. The balance sheet, there's equity and there's the book value of around 337 crore currently, 4,600 crore in terms of market cap. Mind you, viewers, that's something you want to note. So the price to book is quite steep in that sense. The borrowing is at around 140 crores. So why the debt to equity number looks a little bit higher? And mind you, the 75 crore fundraise is not included in the balance sheet at this point. But of course, there's that borrowing of around 140 crore and cash in bank of around 15 crore. This is as of H1 FY26. The March 2026 fundraise, I haven't built into the balance sheet, of course, for obvious reasons. It's tough to kind of build the balance sheet. In terms of cash flow, and when you're looking at the cash flow, realizations have trickled through at a fairly good clip. EBITDA to cash flow conversion is decent. It's only that in FY25, we've not seen that happen. That's obviously because of an inventory buildup that has happened, and that typically does happen in real estate companies. No concerns here either. We've given this a thumbs up from that perspective. Let's look at return ratios now, and return ratios have consistently been above the 20% mark. Therefore, we've given this a thumbs up. No concerns here. Again, everything will depend on execution, as is always the case in real estate companies. I'm also curious to know whether the equity as a component of the balance sheet goes up, and whether debt at all comes in, because that will impact your ROCE ratios as well. Let me talk about the shareholding pattern now. 71% owned by the promoter group at this point, so no concerns from that perspective. We've got 4% FI ownership, which has come in now, and then you've got the balance held by the public. In terms of the stock price performance has been very, very healthy, but outside of that, you're looking at valuations, which is one of the most important metrics when you're understanding companies. You're currently sitting at sub 40 times trailing 12 months. They've done 120 crore of profit over the last 12 months broadly, and at a 4,600 crore kind of market cap, that sits at around 40 times earnings. Now, let me take it across to Sukhdev Singh, who's the founder and managing director at AGI Infra, joining us this morning to give us a sense as to how to look at this going forward. Great having you, Mr. Singh. Let me talk first about the 75 crore fundraise that you've done. Where are you going to put the funds to use? Talk to us about that. Does it mean growth on your existing projects, or does it fast track some of the projects which are waiting for you on the sidelines in terms of land bank?
Yeah, recently we have raised KOIP amounting to rupees 75 crore, and most part of this KOIP it has gone towards the construction of ongoing projects, and a small portion is in the general expenses like approval cost of the project and like that.
And with regard to the projects that you are looking to complete over the next financial year, there are 3 projects in particular that you are looking to complete. Could you give us what the average realization, at least for each of those projects, are? If you can give us a sense first.
The projects which are going on, and we are shortly going to complete the 3 projects. The average we are expecting the average realization cost, realization price will be close to 4,000 square foot per square foot.
Per square foot. Understood. And that's Sky Garden 2, Sky Garden 3, as well as smart homes. Would all 3 be largely in the 4,000 rupee per square foot kind of band?
Yeah.
And how confident are you of completing that in FY27 itself?
We are very, very near to the completion. We are very hopeful to complete it on time.
Okay. So FY27 end, can we expect completion and revenue booking for all these 3? Is that the way one looks at the numbers for FY27?
Yeah, we can expect the completion of the project by the March 27, but the revenue will be booked in the next 2 years.
In the next 3 years, you said?
Next 2 to 3 years.
Why is that so? Because there is still some amount of inventory that you sit on?
Yeah, there is some portion of unsold stock, and we are hoping to sell it within a year or so. Then there is a payment period of about 1 year or so, and likely to complete all the transaction in the next 2.5 and 3 years.
So how much of revenue do you book, sir? Give us a sense. If I've done the math right, you'll do around 2.5 million square foot in terms of completion by FY27, which is for this current financial year. How much, and roughly 4,000 being the realization, how much of that will you book?
So far, about 50% already stands book, and balance 50% will come in the next 2.5 years.
So 50% of this will get booked, which will come straight on your top line. Is that how one thinks of it?
Yeah, 50% will be booked in the year 27.
And therefore, what is the kind of growth clip that one can expect for FY27 versus FY26?
On the basis of last year's many years performance, we are growing at the rate of 10-12% every year, and the same growth is expecting in this year also. However, in the year from the 2028 onward, we are expecting a little higher growth since the ticket size of the flats is going to be much higher in the years to come.
Yeah, if I'm doing the math right, sir, you'll clock a revenue of approximately 450 crore, which is materially higher to the 325 crore number that you clocked in FY25. Broadly, is that the kind of number you're looking at a 20% PAT margin?
Yeah, we are hoping, yes, we are hoping to achieve 20-22% PAT margin. It's achievable, and we are achieving constantly from the last so many years.
Okay, and the 75 crore in terms of equity that you've kind of raised, how much of that is already utilized, and over the next maybe a few quarters, how much, how depleted does that number go to, and how are you using that money immediately? Give us a sense.
It's being used mainly towards the construction cost. You can say 80% of the amount raised stands already utilized, and all the fees, government fees stands paid we recently we got approval of the two projects, one at Chandigarh and one at Jalandhar. The approval cost is already stands full, paid fully, and most part of the QOP has gone to the approval cost, and some part is also spent on the flats.
Yeah, so Greencrest and Utopia, those are your two projects which you're just speaking about. Uh, uh, the completion timelines are beyond FY30, am I right?
It will take about 4 years. Yes, it will four
Yes,
years.
so beyond FY30. And how large are these, and have you got approvals? Have you got complete approval all the way till finishing, or is it a part approval that you've received?
It's 90% already gone, and we are to yet to receive RERA registration and environment clearance of one project. Rest everything is done.
And for that also the realizations are broadly at 4,000. I'm trying to understand whether Chandigarh has better realizations versus some of your other
It
cities.
will be, we are expecting much higher.
Yes. How much
Yeah.
would the number be, sir, broadly?
It will be close to 7,000, 7,500. We are expecting.
Understood.
It will
Understood.
be.
And you sit on a very large land bank. More fundraisers that that one can expect coming from you, or you're very happy going in a in a slower fashion?
Immediately, I'm not expecting to raise. There is no need rather to raise immediately any fundraising, since all the project stands approved and fees stands already paid. It's already there is no requirement of any additional funds.
How have you funded the kind of land bank that you own right now? Have you funded it through debt, equity? How does that work? And do you continue to add to the land bank, or you're happy with the land bank you sit on?
No, it's a continuous process. We are continuously adding our land bank. It's mainly out of the internal accruals.
Okay, so use internal accruals to acquire more land. Is there a plan to continue to do that? And do you plan to diversify into more cities as well, or is it just going to be Punjab and now just Chandigarh predominantly?
See, we have recently shifted to Chandigarh, New Chandigarh. We got 3 locations at New Chandigarh, and hoping to start construction very soon. Certainly, we are looking after certain opportunities in the neighboring state in Panchkula in Haryana. So definitely, if there will be a viable proposal, we'll certainly will expand to the next all other states.
Right. Give us a sense, Mr. Singh, with regard to the debt of around 140 crore that sits on your balance sheet, does that go up at any point of time? Are you happy with that kind of number? Does it come down? Give us a sense.
It's the highest so far. It's the highest ever debt raised, and I'm expecting that in the next 2 to 3 year, company will be totally debt free.
Okay. Is there going to be a change in strategy, or you'll continue to acquire land? Is there going to be a strategy where you do JDAs, or that's not on the table right now?
We are more happy to buy a land and to do our own projects than the JDA. JDA is the last resort.
Okay. Talk to us. You know, you've done around 350 to 400 crore in terms of top line trailing 12 months. Give us a sense of how much of this is rental income from commercial that you earn, and how much of it is residential sales?
It's a mainly residential sale. Mainly residential.
It's mainly
A small
residential.
is out of rental. Very small portion.
Okay, but you plan to increase rental in a significant fashion? If so,
Certainly,
maybe over the next few years, how much does it go up by?
Certainly, there is a plan to raise this rental income significantly in the years to come. In the 3, 4, 5 years, will definitely increase the rental income.
But give us a sense, what would that number be? Would it be 50 crore, say, 2 years from now? If you can just put some numbers, it gives us good perspective.
Okay. Will be close to 25 to 30 crore in the next 3, 4 years.
25 to 30% of your top line in the next 2 to 3 years. Am I hearing that right?
No, 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 no. The rental income from the property, it will be
Yeah,
close to 20-25 crore, no, in the next
20 to
4-5
25 crore.
crores. Yes.
Understood. Yeah, that sounded
Yeah.
a little more realistic. Understood. Understood. Yes. Sorry, that's probably I didn't hear you right. Got it. So 25 to 30 crore odd. And what's the
Out of
margin you make on that, sir? What's the margin IRR or the return ratio you make on that, sir? If you can give us a sense.
Margin out of, hello.
Yes. What would the IRR be, sir, on commercial? If you can give us a sense. What's the construction cost like, and therefore what's the profitability on that part
Certainly
of the
the
business?
profit, yeah, certainly the profitability margin in the commercial is higher, but the demand is little low as compared to the
Okay.
residential demand.
Right.
So
Right.
that's
You're doing multiple very large projects, and therefore you're sitting on large amounts of inventory, even though completion will happen this year. Are you confident of sales?
sure, sure, sure. I feel that still we have just started, and there is a lot of potential in that two city.
How confident, sir, are you of sales happening, of all of this inventory translating to sales? Uh, what could the risks of those sales not coming through be?
Uh, Most of the projects, when we got a very successful strategy so far. When we are starting any projects, our strategy is to sell one third of the inventory before sale, before construction, and two-third of the inventory during the construction in the in the 3.5 year or 4 years, and maybe 10%, 12%, 15% inventory balance at the after completion. It's our strategy, and it's working very well from the last many years.
Yeah, and I'm sure that the realizations may be better post,
Yes,
obviously.
certainly relation is much better at the completion stage.
Correct. And broadly, have you been able to deliver projects on time, or have you faced lags with regard to project delivery? I have obviously
So,
looked through the financials, but I've not been able to find this. So I'm
yeah,
asking you very candidly.
so far every project is on time so far.
Okay. And is approvals a challenge at all for you, or there's no challenge from an approval standpoint that you
It's
see?
not a challenge, but it's a process. Now we have to go through the process. It takes a time about 6 to 8 months. It's a process.
Right. Right. And the cost of materials have gone up for you. I mean, for everyone, frankly. Commodity costs have gone up. Does that at all impact your PAT margin, or are you comfortable with guiding for a 20% PAT margin despite this?
In fact, from the last many years, there is a cycle of material prices ups and down. It's still the price. All the materials are moving in the same fashion. Since we are into construction business from the last so many years, we are keep on tracking the material price or the downtrend. It's exactly as per the as the prices were in the last year. There is no effect of war or anything so far.
So, 15 to 20% growth, can we pencil that in regardless of the kind of projects that are upcoming or ongoing? Should we continue to expect that from a company like you over the next 3 to 5 years?
Sure.
Okay. All right. Thank you so much, Mr. Singh, for coming and speaking to us. You've been fairly candid in that sense. I must compliment you for that. And thank you for that perspective. With that, completely out of time on this edition of All About Your Company. Thanks so much for tuning in. More action to follow. Stay with us here on ET Now.